Welcome to The Explainer. Today, we're going to break down some really powerful financial instruments, the kind that companies use to navigate the, let's say, choppy waters of economic uncertainty. We're talking about derivatives.
I mean, think about it. From an airline dealing with totally unpredictable fuel prices to a borrower facing shifting interest rates, financial risk, it's a constant challenge for pretty much any company that's trying to plan more than 5 minutes into the future.
And this is a huge problem. So, how do they keep themselves from being completely at the mercy of the market? Well, turns out they use a powerful set of tools designed specifically to manage this exact kind of risk.
So what's in this financial toolkit? Well, here's our game plan. First, we'll get a handle on what derivatives actually are. Then, we'll look at the three big ones: options, which are all about the right to choose; futures, which create an obligation to act; and swaps, which are a way of trading risk. And finally, we'll zoom out and see why all of this really matters in the global economy.
All right, Section 1. What in the world are derivatives? Let's unpack the big idea behind this whole risk management toolkit.
You know, at its absolute core, a derivative is just a contract. But it's a special kind of contract because its value isn't, inherent. It's totally dependent on the value of something else. And that something else is what we call the underlying asset.
Okay, so for a contract to be a derivative, it generally has these four key things going on. First, its value is tied to an underlying, like the price of wheat or a stock. Second, it's based on a specific quantity or a notional amount. Third, and this one is a real game changer, it usually requires little to no money down, which gives these things incredible leverage. And fourth, you almost always just settle up with cash. You rarely have to, actually deliver barrels of oil. It's all about the net cash difference.
So let's talk about our first tool, options. And as the name suggests, this is all about giving yourself the right to choose. It's a way you can bet on the future without being totally locked in. And this right here is the magic phrase, right but not the obligation. That is everything. With an option, what you're really buying is flexibility. You get the choice to make a move if the market goes your way, but you can just walk away if it doesn't.
A call option is basically a bet that an asset's price is going to go up. You're locking in the option to buy at today's price because you're hoping tomorrow's price is going to be way, way higher.
This is a perfect example of the power of options. So for just a small fee, Robert got to control the fate of 100 shares of stock. When the price jumped, he used his right, he bought low, and instantly he held shares that were worth more than he paid. Now, if the price had dropped instead, he could have just let the option expire. The only thing he'd lose is that small fee he paid upfront. See the power there? And of course, on the flip side, you've got a put option. This is for somebody who thinks the price is about to go down. It gives them the right to sell at a pre-agreed higher price, even if the market value has totally cratered.
Okay, let's move on to our next tool, futures. And this is where the game completely changes. We can forget about choice here. With futures, it's all about the obligation to act. It's about locking in tomorrow's price today.
This slide right here, this is probably the single most important distinction to get. With an option, you have a choice. With a futures contract, you have a firm, legally binding commitment. You have to follow through, doesn't matter if you're making money or losing it. A futures contract basically locks both the buyer and the seller into the deal. There's no backing out. The price, the date, the amount, it is all set in stone right from the very beginning.
So, you might be asking, why on earth would anyone make such a rigid commitment? Well, one big reason: to completely wipe out uncertainty. And this strategy, it's called hedging. It is the absolute bedrock of corporate risk management.
Let's go back to our airline. By locking in a future price for jet fuel, Skyline gives up the chance to benefit if the price suddenly drops. But what they get in return is way more valuable: certainty. They know exactly what their biggest cost is going to be. That lets them budget and protects their profits from a totally disastrous price spike.
And that brings us to our third and final tool for today, swaps. Now, this one is all about trading risk. It's where two different parties agree to exchange their financial obligations to get a deal that just works better for both of them.
Okay, picture this. You have one company with a fixed rate loan, but they think interest rates are about to fall. Then you have another company with a variable rate loan, and they are terrified rates are going to rise. A swap lets them basically trade places, so each one gets the payment setup they actually want. Let's just walk through what's happening in this table. So Acme has a loan with a fixed 6% rate, but they enter a swap, so they're paying a variable market rate instead. Look at 2025. The market rate is 7%, which is higher than their old 6%, so they end up paying the difference, 5 grand. But then, look what happens. In 2026 and 2027, the market rate drops below 6%. Now the swap works in their favor and they actually get cash. They traded their certainty for a bet that rates would fall, and in this case, that bet paid off. Okay, so we've seen the tools: options for choice, futures for certainty, and swaps for trading risk. But how big of a deal are these things in the real world? The scale is, well, it's pretty much impossible to wrap your head around. To try and put that number in perspective, it is more than 30 times the size of the entire US economy. This is not some niche little market. This is a fundamental pillar of all of global finance. And this brings us right back to where we started. Yeah, you hear the crazy stories about derivatives being used for high-stakes gambling, but their primary day-to-day purpose is to solve that fundamental business problem of uncertainty. It's what allows companies, like our airline, to operate smoothly in a super volatile world. And that really leaves us with the central tension of it all, doesn't it? Are these things the essential shield that protects our economy, letting businesses plan and grow? Or are they a high-stakes casino with a stack of bets so massive it could bring the whole system down? Well, the truth is, they're both. And understanding that two-sided coin is absolutely key to understanding modern finance.